and welcome back to the Abundant Living University. I'm your host, Glenn Ullman. I've waited a couple of weeks to do this video on the large trading losses at JPMorgan Chase. What started out as a $2 billion loss is probably going to end up at about $4 billion. And the reason why I waited is I was hoping that somebody could explain to me in print form, whether it was the Wall Street Journal, Bloomberg, the New York Times, what exactly the trade was and how did it go so wrong. And the sad thing after 2 weeks is that despite pages of print, it's always described as a hedging strategy, a complex hedging strategy. And the reality is if the best managed bank in the United States cannot figure out how to do this well, then there's a problem. So what really happened here is that JPMorgan Chase is saying they had a big position. So let's say they had a $100 million position in Philip Morris, and they wanted to hedge in case Philip Morris went down. Well, historically, there have been two ways to hedge a position. One is have lots of cash. So if your Philip Morris goes down, you have cash on the other side of the balance sheet to make sure that your institution stays healthy. It also would allow you, if you still like Philip Morris, to be buying some at lower prices. The other way to hedge has been puts and calls. Puts and calls are options that allow you, if the stock went down, to essentially have sold it at a higher price. Now, it's impossible or near impossible to have a $4 billion loss on either of those two strategies. What happened in JPMorgan Chase's trade is that there was huge leverage involved. This should sound familiar because this is exactly what happened in 2008. Credit default swaps and other derivatives. By the way, you can't describe this trade in pages upon pages. You probably shouldn't be doing it. But just like in 2008, leverage was applied. Now, we use leverage all the time in our daily lives. You could buy $1 million house using leverage, and we do all the time. 20% down, $200,000. We borrow roughly 3 times, right? We borrow the $800,000 to buy the house. In this case, the $100 million trade was leveraged 30 to 40 times, which creates a $4 billion loss. So the issue is, why is this happening again? Why have we allowed big institutions to essentially be gambling in terms of leverage? Don't get this wrong. The reality is that JPMorgan Chase in this division, and many banks are the same and investment banks are the same, this is a profit center. They've made tens of billions of dollars by these trades working out correctly. So instead of losing $1 billion or $2 billion or $4 billion, they've made $2 billion, $3 billion, or $4 billion. The problem is that with leverage, these trades are a systemic problem to financial institutions. And this is not a local problem. This is a global problem because money is no longer local, it's global. What's the solution? The solution is, one, not allow big institutions to trade FDIC deposits in this way. That's just common sense. People have called this the Volcker Rule. I just call it common sense. You can't trade money that's essentially guaranteed by the taxpayer. You want to trade investors' money? No problem. Investors get hurt, they get hurt. It doesn't destroy the bank. The other thing is we must regulate leverage. This is done in the brokerage world all the time. You can't leverage a stock trade 40 times. There are margin requirements. The same thing needs to be done in the banking system, in the investment banking system, and in the hedge fund world, because that's the next thing that'll blow up. Because hedge funds take huge bets, 30 or 40 times leverage, and guess what? If it doesn't work, they close the hedge fund and start over again. So in the world in which we live, prudent structure around leverage is the only thing that's going to safeguard us from another 08 and 09. How do we do that? Write your congressman, write your senator. And, as always, love to hear your comments.